There's lots of hype around the benefits of duplex investing, but there's a new dual income investment strategy on the block. Hey everyone, Kim from GeoTax here. Deciding on a property investment strategy can be a daunting task, but an excellent place to start is considering all your options. You never know. Maybe the dual key strategy would fit perfectly into your investment goals. Stick around to the end because I'm going to be sharing with you all the pros and cons so that you can decide if this is a potential strategy for your investment property. Before we get into it, we want to be clear that this video is for informational purposes. In no way should you interpret this as tax advice. We always recommend working with a qualified accountant or tax agent who can give you the best advice for your situation. A dual key property is essentially one main property that looks like a standard home from the outside, but it's designed and divided into two separate units. So think of it as a mix between the concept of a duplex and a granny flat. It's two units in one property, but instead of two mirrored units like with a duplex, it's usually a house on the one side with a unit on the other side or even inside. Generally, dual key homes will have one front entrance door or foyer that will lead to the two different lockable doors. So unlike duplexes and separate granny flats on the property, a dual key home is one space shared by two individual tenants. The most obviously attractive aspect of a dual key home investment strategy is that you'll have one home with two portions that can be rented out. So you'll have dual occupancy. The strategy is that there is potential to generate two rental incomes with only one property to manage. This means that you'll have two income producing properties on the one title, and you'll likely only have to pay counter rates and body corporate fees for one property instead of two. The idea is that investors could be in a positively geared position where the property generates enough positive cash flow to maintain itself through the rental income. The second possible advantage with dual key homes is that property investors could live in one half of the property and rent out the other half. So, instead of you having to repay two loans, one for the property you live in and one for your investment property, you're only paying one and you're generating some income to contribute to the mortgage repayments. On the other hand, the second unit could also be used to create more privacy within a family if you require extra space for a parent or an elderly relative that needs to be cared for. However, many property agents and experts seem to be warning property investors against the risk of investing in dual key homes. Let's take a look at some of these pitfalls. One of the most notable risks is that dual key homes are generally more attractive to property investors and not property occupiers. Other than the benefit of having family members close by, still somewhat separated, not many people enjoy the idea of sharing the same building with other people. It's also worth keeping in mind that the owner-occupier rate in Australia is around 70%. So, if owner-occupiers aren't necessarily looking to buy dual key homes, the potential resale market is significantly reduced, meaning there will be limited capital growth on the property. There is also not much evidence out there pointing towards dual key homes being in high rental demand. So while there's the potential to generate two incomes, it may actually end up being difficult to find tenants to generate that rental income. Another knock-on effect of these properties not being in high demand is that lenders are likely to be stricter when determining whether you can meet your loan repayment, and they're going to want higher deposits. The good news is that if you decide to invest in a dual key home and none of this is an issue, you're entitled to a significant amount of rental property tax deductions, more so than the average rental property. For example, dual key homes attract high amounts of depreciation because there are at least 2 bathrooms, 2 kitchens, and sometimes even 2 laundries that you can claim deductions on. But keep in mind that if you're renting out one part of the dual key home and occupying the other, you'd have to apportion the deductions based on which portion of the property is generating rental income. So there's a lot to weigh up and consider. If you're looking for any help in making your decisions, we always suggest reaching out to a team of property professionals. If you have any questions for the quantity surveys at Geotax, please drop them in the comments below. And if you got a lot of value from this video, check out our YouTube channel to subscribe for more. I'm Kim Quach from Geotax. See you next time.